Welcome to the Deep Dive. Today we're taking a stack of financial reports, specifically from Oracle Financial Services Software Limited, or OFSS, and really getting into the weeds for you.
That's right. We're looking at their latest results.
Exactly. Our mission here is to analyze the unaudited, standalone, and consolidated financials for their second quarter, Q2, and the first half, H1, of their fiscal year. That period ended September 30th, 2025, and these numbers were just released, reported to the exchanges on October 17th. So pretty fresh data.
Yeah, and interestingly, the biggest news wasn't actually buried deep in the spreadsheets. It came straight from the board meeting that same day.
Oh, what was that?
They approved a really significant interim dividend. We're talking Rs 130 per equity share.
Wow, 130 rupees. Okay.
Yeah, it's a huge signal. We definitely need to unpack what that means alongside, the actual performance figures.
Okay, absolutely. Let's start unpacking that. Let's look at the consolidated report card first. Comparing Q2 of this fiscal year, FY26, with the same quarter last year, Q2 FY25. What are the main takeaways? What did the top line look like?
Well, the initial numbers, they kind of show the split picture. You've got strong growth on one hand, but a bit of a squeeze on the other.
Yeah.
Consolidated revenue climbed to Rs 1,789 crore. That's about $215 million US dollars. It's a solid 7% increase year over year.
7% growth. That sounds good.
It is, but operating income, that only nudged up 1%, just 1%.
Yeah.
So Rs 731 crore.
Okay, so revenue up 7%, operating income up only 1%. They definitely bought that growth.
Exactly. That's the trade-off, right? It really hits at the core of what's happening with the stock story right now.
So how did that difference, that slower operating income growth, affect the bottom line, the net results?
Yeah, it hit them. Net income for Q2 actually went down 5% compared to last year. It landed at Rs 546 crore.
Or 5%.
And yeah, consequently, basic earnings per share, the EPS, it basically followed right along, dropping 6% to Rdino 62.84.
Okay, so that divergence.
Yeah.
Revenue growing, net income shrinking. Is this just a one-quarter thing, a blip maybe? Or does the half-year data, the H1 numbers, show the same kind of margin pressure?
No, the trend definitely holds when you look at the full first half. For H1 FY26, revenue was Rs 3,641 crore, still up a strong 7% over H1 last year.
Right.
But net income for the half year saw a 1% decline, just a slight dip, settling at Rs 11,188 crore.
So the pressure is consistent then?
It is, and it really raises the key question, what's dragging down that net profitability? It seems likely it's, maybe aggressive hiring to support that 7% growth, or perhaps some upfront costs for these new complex cloud deals they're signing.
Investing now for later payoff, maybe?
Could be. They might be absorbing costs now to get that recurring subscription revenue down the line.
That makes sense. I think the management commentary mentioned the margins for the half year. Operating margin was 43%, net margin 33%. Now, 43% operating margin sounds high generally?
It is. Historically, OFSS margins are really strong, industry-leading, in fact.
But how does it stack up now? Maybe compared to, say, the financial services arms of competitors like TCS or Infosys.
Yeah.
Or is OFSS feeling a sharper squeeze compared to them?
That's the key. While 43% is high, when your revenue grows 7% and operating income only grows 1%, it signals that the operational leverage isn't quite kicking in like investors might hope. It's definitely a pressure point to keep an eye on.
Okay, so if margin pressure is the main story, let's try and pinpoint where it's hitting hardest. Let's look at the core business segments.
Exactly. Let's break down Q2 FY26 by segment. The products business. That's still the giant here.
Right.
Its revenue hit Rs 1,623 crore, up 7% year over year. In that segment, it accounts for 91% of the company's total revenue.
Massive. 91%. Okay, so that's the engine. What about the smaller services business, the other 9%?
The services side brought in Rs 166 crore in revenue. That was up 6% year over year.
Okay, so both segments grew their revenue.
Yes, both grew top line. But, and this is key, when you look at the segment results, the profitability of each segment, that's where you see the efficiency issue really concentrated.
Oh, okay. How did that play out?
Well, the contrast is pretty stark. The product segment results were up 7%, basically mirroring its revenue growth, nice and aligned.
Good.
But the services segment results, they were actually down a hefty 15% in Q2.
Down 15%. Wow. That suggests a really significant difference in efficiency or perhaps investment levels between the two.
I think that services segment result being down 15% is almost certainly the main culprit for that overall margin drag we saw in Q2.
Right.
This often happens when you're shifting towards more complex cloud projects. You've got heavy costs up front, maybe retraining staff, getting new tools, setting up for new contracts, all before that steady recurring revenue starts flowing in.
That's the nuance. Okay.
Mm-hmm.
That makes sense. Now let's circle back to that huge dividend announcement. If the consolidated net income is down 5% for the quarter, why is management declaring such a large, seemingly confident interim dividend? ROS 130 per share again?
Yeah, it's a head turner.
Does it just mean they're swimming in cash? Or are they maybe choosing to return cash now instead of finding ways to reinvest it internally for growth?
It definitely signals, first off, exceptional cash reserves. OFSS is known for being cash rich, even with that slight dip in net income recently.
Okay.
But it also might suggest they don't see, perhaps, enough high-return organic investment opportunities right now. Giving cash back to shareholders might be the best use for it, in their view. It absolutely affirms management's confidence in the underlying stability and that recurring revenue base.
Right. So for anyone holding the stock or thinking about it, what are the key dates they need to know for this dividend?
Okay, crucial dates. The record date to be eligible for the dividend is Monday, November 3rd, 2025.
November 3rd.
And the dividend itself is scheduled to be paid out on or before Saturday, November 15th, 2025.
Got it. November 3rd and November 15th. All right, let's shift gears a bit. Beyond the immediate profit and loss, what about the forward-looking signs? Which parts of the world were driving growth? And what kinds of revenue streams look the most stable?
Yeah, looking geographically, there's an interesting shift happening. It seems established markets are gaining ground. The largest single region, the Americas, specifically the USA, its contribution to total revenue actually increased. It went from 26% last year up to 30% in this Q2.
Okay, a noticeable jump in the U.S. share.
Yeah, and conversely, the Middle East and Africa region saw its share dip slightly from 19% down to 17%. So it looks like the focus is really paying off strongest in North America right now.
Interesting. And within the big products business, you mentioned stability.
Right.
What does the mix of revenue tell us? Like license fees versus ongoing support?
Right. That recurring revenue is the foundation. And stability really comes from maintenance. Maintenance fees made up a significant chunk, 36% of the product's revenue in Q2.
36%.
License and the newer cloud fees, they accounted for 11%. The rest, about 53%, came from consulting fees, helping clients implement the software.
So that mix shows a company really generating a lot from supporting its existing customers. That 36% from maintenance is pretty high.
It is. It's just really deep, kind of sticky relationships with their clients.
And to sort of validate that future potential, we really need to look at the RPO, the remaining performance obligations, right?
Absolutely. That's the hard number that gives strategic validation. The RPO figure, it stood at a very hefty Rs, 6,349 crore as of September 30th. That's over $750 million US dollars.
Wow. And just to remind listeners, RPO is basically
contracted future revenue, money that's essentially guaranteed based on signed deals but hasn't hit the books yet.
right.
So yeah, having over 6,300 crore rupees in RPO acts as a really solid multi-year safety net. It definitely underpins why management feels confident enough to issue that big dividend.
Okay, so the RPO gives us the big picture confidence level, but this specific client wins. They're like whispers from the market about what's actually in demand. Let's dig into what OFSS is selling. What services are really hitting the mark right now?
Yeah, this is where it gets really interesting. What's fascinating is just the sheer diversity and the global spread of the new deals. And there's a heavy, heavy focus on modernization, compliance, and definitely a tilt towards cloud delivery.
Could give us some examples.
All right, so in North America, you had an established bank there and also a U.S. regional bank, both signing deals for financial analytical applications. And significantly, the regional bank is specifically using a cloud infrastructure for that.
Cloud analytics. That feels like a key shift, doesn't it? Not just core banking anymore.
Exactly. That cloud analytical adoption is a critical sign of how the market's evolving.
Where else were they landing big platform deals outside the U.S.?
Well, we saw modernization happening in both established and emerging markets at the same time. A large Japanese bank, for example, is investing in OFSS's digital banking platform for its operations in Singapore. That's a big commitment in Asia.
Okay.
And even more dramatically, maybe, Jet Albania S. Asia. They're set to be the very first digital-only bank in Albania, and they're implementing a whole suite right from the start: core banking, credit, payments,
Yeah.
the works from OFSS.
Wow, a completely new digital bank built on their tech. That's a huge endorsement, a real digital-first win.
Absolutely.
What about those high-growth regions like the Middle East and Africa? Are they still seeing activity in core banking upgrade?
Oh, yeah. Strong activity there, too. Poshepia Bank, OJSC, in Azerbaijan, they broadened their investment in OFSS core banking.
Uh-huh.
Also, a major private bank in Ethiopia signed up for core banking apps, and a Nigerian commercial bank selected their core banking, too.
So plenty of demand still for just upgrading the fundamental systems.
Definitely. It's clear that core system enhancement is still this huge global opportunity, especially in financial sectors that are modernizing rapidly.
And finally, what about regulation? Risk and compliance are always big drivers for tech spending and banking.
Always. And we saw that too. KGI Commercial Bank in Taiwan and also a major Brazilian banking institution both picked up OFSS financial analytical applications specifically for compliance and risk oversight.
Right.
So yeah, the need for better regtech, regulatory technology, it just keeps fueling sales all over the world. It shows OFSS isn't just selling core systems, but these specialized high-value applications as well. #tag outro.
Okay, let's try to synthesize this quickly.
Yeah.
OFSS showed solid top-line revenue growth, 7% in the first half of FY26. That's backed up by a really substantial RPO over R's 6,300 crore and some impressive global client wins, especially in cloud analytics and core modernization.
Right, solid growth.
But despite that, the Q2 results did show that slight dip in consolidated net income and EPS. It seems largely driven by those short-term margin pressures in the services segment, probably due to upfront investments.
Yeah, that services segment drag seems key for the quarter.
And critically, that huge interim dividend, Rs 130 per share, signals really strong management confidence in their long-term financial stability and their cash position.
Absolutely. And if you connect this to the bigger picture, all these investments we're seeing banks make in analytics, in core banking, across both emerging and established markets, especially that U.S. bank moving its analytics to the cloud, it just clearly demonstrates that the global financial services sector is still aggressively trying to get away from old legacy systems.
Yeah.
OFSS is definitely riding that modernization wave, even if, it creates some temporary bumps in their expenses along the way.
That makes perfect sense. Okay, now here's a final provocative thought for you, our listener, to chew on. We heard that maintenance fees still drive a big chunk, 36% of their product revenue, but all the exciting new wins seem to be about cloud analytics and digital platforms. So the question is, how successfully is OFSS converting that old-school recurring maintenance revenue into the potentially stickier, higher-growth cloud subscription revenue? Or are they effectively still running two quite different business models side by side? That conversion story, that's what we really need to watch in the coming quarters.